Asset Management, and Rachel Aiken is Vice President and Portfolio Manager at Rockland Trust. Welcome to both of you. Rachel, let me begin by asking you, one of the things you say is that if you look at the broad indexes, you can't help but notice that they feel stretched. They are, by traditional measures, if you look at the 10 biggest stocks, if you look at the general S&P. But below those market big barometers, there are pockets of opportunity. Explain that argument and explain where the pockets are.
Sure. Tyler, thank you for having me on today. And yes, at the index level, you are looking at valuations that look toppy. Again, I think one of the things we look at is to try to look under the surface at the sector level and company specific level. And there you still see PE multiples a little bit higher than historical averages, but not nearly as high as the distortion I think you see from the top 10 market cap names in the S&P 500. So again, there you're looking at valuations that are maybe 120% of their historical averages instead of 140 or 160, perhaps when you factor in those high market cap 10 top stocks in the S&P 500.
You like a couple of energy names, and we'll come back to them in just a moment. But Brian, let me turn to you and get your thoughts over the market's relative level compared to history, and also where the 10-year bond is going and what it could be telling us about possible inflation down the road. It's up. The yield is up decidedly today.
Yeah, it has been quite a move higher in the yield. And if you look at what's been happening with the 10-year Treasury over the last few weeks and even the last few months, most of the move higher has actually been driven by an increase in inflation expectations, so as measured by the break-even rate of inflation. What hasn't really moved that much higher has been the real interest rate. So after you adjust for the inflation expectations. And we think that that's actually what could help move yields slightly higher from here, is that improvement or an increase in the real yields. Now, that's important because we think that not only will it obviously pose a little bit of a challenge for investors in Treasury securities, but it is typically correlated with better expectations of growth, which could bode well for the more credit sensitive sectors of the fixed income market, like higher quality, high yield, lower quality investment grade, but then also for the broader equity markets. Because if yields are moving higher because of the growth outlook is improving and not necessarily just because inflation is picking up, that should bode well for those more cyclical parts of the market that we like small cap, value, and emerging markets.
Shepard Smith here. Thanks for watching CNBC on YouTube.